guys feeling charitable?
I had a conversation with someone right now.
But
That was a guy.
say more.
That guy over here that was at the what's that poke place? Downstairs.
Yeah, underrated.
I've not been there, but yeah, he used to be the chair for Casa when I first got on.
How does that conversation start at a poke bowl place and then it leads to charity? I'm so curious.
Yeah, wait, so hold on. Wait.
I saw him in the window.
He was asking you for a charitable donation, or you were telling?
I went to go ask him for his.
Oh, okay.
He told me to let him know with the next one here. Like, I'll send a check. Don't worry about it.
Oh, okay.
All right. Well, did you know that in 2023, Americans gave over $500 billion charitably?
Did not know that.
All right. Well, that's a little fun fact. How about this? If you had to guess where most of the giving came from, individuals, corporations, foundations, where would you say that money came from?
Corporations, just first guess, just because they have the most.
Individuals.
I know the answer. It's individuals, but you cheated. No, I cheated.
You cheated
personally.
How did you cheat?
I don't know, but but you would think it'd be larger corporations trying to make substantial, trying to take care of some type of substantial tax liability and do some gifting, be philanthropic. But it is interesting that it is individuals.
Yeah. So of that 500 billion that was given by Americans, about 375 billion is given by individuals. Wow. That equates to about 2% of their income. So I think we should talk about some charitable giving and ways to give more tax effectively. And one of the reasons being is that charitable contribution deductions are itemized deductions, and only 9% of Americans itemize. That's down from 31% from back in 2017.
Why is that?
Why is what?
Why is that? Why is it down so much?
Well, standard deductions have gone up significantly since that time frame. So it's people are less inclined, or there's less of a reason for them to itemize.
Or you mean they can't itemize at that point?
No, well, it depends, right? Depends on what they're deducting, what their expenses are, there's multiple factors. But with standard deductions going up as they have, there's less of a reason for them to try to itemize by really gathering or looking at what those expenses are, or if they can even meet it. Most of the time, they can't meet what that deduction is. So I think people don't realize that the gifting that they're doing isn't even eligible for the tax benefits they think they're receiving because they're not even itemizing in the first place.
Yeah. You know what? I'll use my own personal story as an example. CPA said, hey, I need all your deductions and all your charitable contributions for the year. And I told them, well, I'm not going to itemize, so I'm not going to even bother giving you my charitable contributions. But a lot of folks, when they're asked, they will do it, and they automatically assume that they're getting a tax deduction off of it.
Right.
And then when you look at their tax return, it's like, hey, you're taking the standard deduction. You're not even getting any benefit from that charitable contribution that you made.
Yeah, just for our millions of fans watching, just to clarify,
All over the world,
and Mars. The standard deduction for an individual, for a single, is $15,000 in 2025. And it's $30,000 for joint, so it's a big deduction, and so most people feel like when they itemize, they're not going to be able to go above that threshold.
So you bring up a good point, James. Okay, so we've established that charitable contributions are itemized deductions. What are some other itemized deductions?
The most common one that people are familiar with is like mortgage interest and points, and so you add these things up on top of your charitable contributions, and if that figure is more than the standard, then you might want to choose the itemized deduction because it'll give you a bigger deductions.
Now, I've heard about this bunching strategy.
Yeah.
In order to have enough itemized deductions go past the standard deduction limit.
Yeah.
Can somebody tell me what that strategy is?
Yeah. So what bunching is the concept of taking multiple years of gifting and doing it all at one time. So if you're someone that is charitably inclined and you do a specific gifting dollar amount annually, and you do that, and you're going to be doing that for years and years and years, well, it could behoove them to take all of the gifting amounts over the next couple of years and do that all at once, itemize for that single tax year, And then moving forward, use standard deduction.
Yeah.
After that.
Yeah, we've seen that scenario play out where, since interest rates have gone up, so our clients that have checkings and savings and CDs, their taxable income go up. Yeah. So that's where bunching can help. If you itemize your deduction, it's more than the standard deduction. This year you're going to be paying higher taxes than usual. Then it would be good to bunch it all in 1 year.
I always find, I don't know, numbers kind of help me. So let's say you give $10,000 a year. So you take 5 years worth of charitable contributions. Yeah. So $50,000. You do it in 1 year. That's over the $30,000 standard deduction James meant. So now you can itemize for that year.
Right.
But so how you mentioned a specific charity earlier. What would that be like? Like giving them $50,000 in 1 year.
For a lot of organizations, that'd be a big donation for them, and that could really help them, especially if they were dealing with some of the cuts that were going on right now, right? So I happen to serve on several nonprofits, and right now funding, especially from the government, is starting to become limited. And so finding those resources to be able to fulfill your mission, whatever that organization may be, big chunks of money at any point in time can be a huge boost for them, especially if they're in needs. And so I think that looking at how that's going to impact them it is a big deal, right? Because some of them may not need $50,000 at one time, but I would say most smaller ones, $50,000 would go a long way.
Yeah. Okay. So that's an interesting point, right? Because the other side of it too is, all right, so are you going to be around in 5 years if I give you $50,000? So what are some ways that people can address that concern?
Yeah, so a couple different, there's an array of options that are out there, right? Donor advised funds, where you make a contribution to a fund that could be utilized in a way to where you get a tax deduction today and you get an opportunity to make disbursements out of that fund to whatever organizations, nonprofits that you would like to donate towards. They do need to be, for the most part, 501c3. They do have some limitations and restrictions, so make sure that you verify what it is, what causes you're looking to fulfill, that they actually are able to make those grants to them. There's some different options with annuities. I don't know if there's charitable gift annuities. There are charitable remainder annuities. Can't think of the other one.
Yeah, with the donor advice funds, that a lot of people are starting to really like that because of the flexibility and control. Where when you make a donation, you get an immediate tax deduction, but you don't have to send those monies to charities until you're ready. But you get an immediate tax deduction today. And so it gives you a lot of flexibility. It
is great. I think sometimes it gets misconstrued as far as how the tax benefit does work for it, because I know we've spoken with clients, and the assumption for them is that when they make the donation into the DAF, they get the tax benefit, and then when the funds are distributed out of the DAF, they also get a tax benefit, and that's not the case.
Yeah.
Right? So you make a $50,000 contribution to your DAF. At that point in time, when that contribution is made, that's when you get the tax benefit at that point. The distributions out, you can do that at any point in time, but when that does occur, there is no tax benefit for that individual at that point in time. So if they wanted to make a charitable distribution out this year, $5,000, so be it. Next year to a different charity of their choice that qualifies, $10,000, they can do so. But every time that dollar amount is distributed, there's no additional tax benefit or deduction.
Yeah, I think one of the nice things about them too, right, is that you have control over when you make those disbursements, and you don't have to necessarily do it immediately. A lot of the DAFs will allow you to invest that money, and you can actually earn some interest on top of it. So not only do you get a chance to get the deduction today for whatever dollar amount it is, but there's a chance, a higher probability that you're going to be able to donate more than that initial amount that you contributed into the fund. Some
details with the DAF too, because I mentioned flexibility and control, something for our fans to consider. And that's the DAF is a sponsoring organization. It's a 501c3 organization, and you want to check if that DAF, if they have your charity that you want to contribute to as an approved charity. Because technically, when you give them your donation, legally it is now owned by that sponsoring organization. Okay, and so for the most part, you need to make sure that your list of nonprofits that you want to contribute to is an approved nonprofit under that organization. Yeah.
Yeah, it's a good point.
Yeah, I think for the most part, right, I normally give a list. My client will give me a list of the organizations that they want to sponsor, that they want to make donations towards.
Right.
I'll submit that list to the DAF that we're looking at utilizing. It'll get approved at all those organizations, or if they're not on there, they'll actually do some research and verify that they are a 501c3. Once that gets approved, then every year that the client wants to make that disbursement, right, they'll give me their dollar amount and the list of the organizations they want to contribute to.
Right.
We submit it. The organization will then submit grants to those nonprofits that they've selected.
Yeah, I think it's funny if you think about the name Donor Advised Fund.
Yeah.
If you're the donor, you're advising on the fund.
Yes.
You don't control it, you're
Yes,
advising. So
Right.
the way that looks is you're recommending a grant to the sponsoring organization.
Right.
And it's up to them whether or not that they're going to approve it. Because you could get in a situation where the charity that's going to receive the grant, its mission is not in line with the sponsoring organization. So I think that's important to do on the front end.
Yeah.
I think it's also kind of interesting too, just the different options that are available, right? When we first got into this industry, right, some of these options weren't available. As we've changed broker dealers, different options have become more and more available. So I think even having that conversation with the client as far as how is it being managed, who's managing it, is it a local, is it a corporate, what does that look like? And I think that those are things that clients need to ask.
Now, you mentioned a tax deduction when funding a DAF. Do you get to deduct the whole thing?
No, unfortunately, there's limits, and it's based on what you're going to contribute into that DAF. For example, if it's cash, the max you can deduct is 60% of your adjusted gross income, or AGI. If it's a long-term capital gain property, it's 30% of your AGI. So that's something you want to be aware of when you're making that donation. You're not going to be able to deduct the whole thing, but it's still a pretty significant benefit.
Okay, wait a minute. Long-term capital gain property.
Yeah.
What do you mean? I can donate real estate? You said property?
Yeah, you can donate real estate. You can donate even highly appreciated stock. Stepping back a little bit, you can always donate stock directly to a nonprofit. But when you do that, because sometimes what we've seen is people will sell a stock, take the cash, and then donate it to a charity, versus just transferring the stock directly to that charity. And so when you transfer it directly, you avoid first paying capital gains taxes, and then now you also get to deduct a portion of that contribution once it's in the DAF.
Yeah, with appreciated real property like that, over time, because of the 30% limits, it is important understanding what the dollar amount is and what the actual long-term capital gain is in these circumstances, because you can choose to take the cost basis at a 50% of AGI limit, which in some circumstances could be higher than the 30% limit based on the long-term capital appreciation. That way, you're able to take a larger deduction immediately instead of having to spread out that deduction over time. So there's certain considerations when it comes to how you do it, whether you take it as the fair market value of whatever that specific item is, whether it is real property, whether it is stock, whatever the case may be. But considering what the tax situation is for you during that year could determine how you claim the deduction for that real property.
Okay, so using the same numbers I used earlier, if I want to give $50,000 in 1 year, and you mentioned a 30% limit of AGI, so if my AGI is 100K, I can only use 30K as a deduction. What happens to that other 20K?
Yeah, so you can carry that over for 5 years. So that's kind of cool.
Okay. So I don't lose the deduction.
No. Yeah. But as cool as DAF sound, there are some critics though. Yeah, I said it's cool.
I was gonna say, what do those jerks have to say?
No, I mean, when you really think about it, right? You
Are they named Scrooge and the Grinch?
I mean, you get an immediate tax deduction, and then we just mentioned you can wait to donate or grant that money to an organization.
I think it's those organizations that want.
So
the money
how long are you waiting, buddy?
Yeah. What's that? What's the time frame on that?
Yeah. So you got the deduction.
Well,
these charities are kind of waiting.
Yeah.
So.
We're in a down market. Want to wait for a little capital appreciation there. So. Yeah.
Earlier, you also mentioned about that you can donate stock directly to a charity. I have found that some charities don't have a way to receive that.
Yeah.
So the DAF could be a nice middleman to get that done. What are your thoughts around that?
Yeah, the last few years, DAFs have gotten more popular, and there's been more and more money going into them, and they just have a better infrastructure, being able to take different types of investments or cash or property into these funds. So you're right.
Yeah, it's difficult, especially if you're gifting items, right? You're gifting like real, true, appreciated items, collectibles, things like that. It's difficult for those charities to they're just like, oh, thanks for this artwork that's $50,000. What are we going to do with this piece of art? Like, there's certain things that it's difficult for them to manage the asset, store, keep the asset, and then actually get the true value out of the asset as well too. So these middlemen or these capabilities of being able to determine the true value of that stuff, that makes a big difference.
But that being said, I wouldn't sleep on your local community foundation and just check with them. Hey, I know you guys are a smaller organization. Would you be able to take my donation? And how does that look like? Because those community foundations, they were one of the ones that first started donor advised funds. They were sort of the pioneer, and so it's kind of cool when you have a local community foundation and you can actually get to pick a local nonprofit that you get to support. So I wouldn't sleep on those foundations.
Speaking of difficult to value things,
what if you just did something recently?
Yeah. Well, I'm curious. All right, so I've come across situations where you have a single person with no heirs, and they're charitable, and they have their house. And so they make provisions in their will for the charity to receive it upon their passing. What is a better way to do it?
So something called a charitable remainder trust is something extremely beneficial in the circumstances. In a circumstance like that where they know they're going to be gifting, especially real property, their personal property, what you would do is you would put that property inside the trust. Okay. And what the trust would allow you to do is remain in the property, continue to live inside the property, continue to have your normal daily activity and utilize it as personal property. You get to take the tax benefit from the estate and eliminate it immediately while you're living. The property then goes into the trust at passing. At that point in time of passing, then whatever is listed inside the trust would then go to whatever charity is designated in the trust at that time frame. So they can start to receive tax benefits, and that's one of the things we've talked about all the time, right? Is why wait until after death to get the tax benefit of gifting when you can start to receive that benefit today? And reap the rewards of that benefit, along with meeting all your charitable and philanthropic needs and wants as well.
Yeah. So what are some other ways to do that? Like I'm thinking, okay, so I've seen scenarios where people will name a charity as a beneficiary of their life insurance policy.
Yes,
I was just thinking about that one right now. That's the one I'm like thinking that's not the one to be gifting to the organizations, right? Because that's already tax free, right? It's a tax free instrument that you're passing on to an organization that's already getting tax. They're already tax exempt, and so I think that's always a conversation with. When you're having this with clients on what are they trying to do, what are they doing, kind of going back to, is there a better way of doing it, right? As a kid, if I was receiving the inheritance, right, and I looked at my parents and they gave me IRA money versus the life insurance money, I would have been like, hey, we should have done it the other way, right? On the IRA money that they received,
Would you would have known that as a kid?
I would have studied probably pretty hard, because
when you were a kid, there
Mom.
was no. Well, worse when he was a kid, there was no Google.
There was
Like,
no-
what do you do? So you're going to encyclopedia.
Encyclopedias. You're at the library.
Where's the reference section? Reference section, sir.
it's amazing what you can find in a library.
How about the Wall Street Journal, sir? Where can I find your latest edition?
Yeah. How old are you, kid? Get out of here.
You don't even have a library card. Yes, you need library
You
cards.
library card. You did.
Okay, I'd argue there's an even better way than that.
Oh.
Yeah, I said it.
Oops.
Do tell.
Can anybody? No, I mean, what's a better way? What's a better way than giving at death? Because right there, what you're saying is true, right? Like, who's the best beneficiary of everything? But at the end of the day, it's a beneficiary, so you need to
No matter what. You're right.
Deceased.
Right, and you don't get a tax benefit when but you do during life.
Yeah.
So what's a better way?
So there are what are called charitable remainder annuities. And that is a really unique tool that actually allows you to receive deductions, charitable deductions today for a specific dollar amount that you would like to donate, but also receive an income benefit over the life of the annuity. So it's a strategy that you receive while you're living, the tax benefits of what you would eventually do after death. And still, if there's a concern from an income basis or being able to have access to some of that funding, the annuity will provide an income stream for you over that time frame, with then eventually then the assets passing over to the charity of your choice, whichever you designate within that as a beneficiary of that annuity. So that's one tool that we've seen. The issue is there are limitations as far as, in some circumstances, how much you can fund these annuities as well too. But that's one way to be able to utilize and be able to take the benefits while you're living and still receive some income as well. What else? What was the other one you're thinking of?
I'm sorry, but when you just said that, I thought of a different podcast.
You went back?
No, so I don't know if we can say this, but remember the Theo Von podcast with, I think he was on Joe Rogan, and Theo Von just goes, let's see.
There's just like no topic whatsoever. There's like one topic was done. They're just like, what else can we talk about?
It was kind of funny. Anyway,
great.
no, okay. So what I had in mind was, so there's a way that you can give your house to charity, directly to the charity, and continue to live in it for the rest of your life and get a current tax deduction. There's some IRS formulas to figure out what the deduction would be. But yeah, I would argue that that's a better way to do it than the charity to receive it upon your passing.
You had something else in mind, though.
Yeah, there was
besides
something
that.
else.
Yeah. So, okay. So
You got that look.
Yeah, I saw it. I was like,
do I throw in inter vivos? I love that. Giving inter vivos is much better. I'll just leave it at that. Okay. I like that term, inter vivos.
yeah.
Per stirpies. Sorry. That was a throwback to a different podcast.
That kind of reminds me. Yeah, I mean, you guys already mentioned it, that generally speaking, we prefer that clients give while they're still here, so they can see the benefits of that gift. But it comes down like when I was a noob advisor, a client would just
Like a month or two ago.
A client would mention, hey, I'm going to donate to this charity. It's in my will. It's like, okay, cool. There must be a reason.
Sure.
I'm not going to question it. I just started. And then it just comes down to a conversation, because most of the time, clients will be like, oh, that's in there? I didn't know that. I'm going to be giving this amount to charity after I'm not here. So it just comes down to having a conversation with that client and really understand how important is giving to them as a family, and then taking it from there. And for most cases, they people want to give while they're still here so they can see the benefits of their gift.
Man, I'm so glad 25 minutes into it, we finally got real.
He wanted to hit the corazon.
Look, this is where this topic was born. And this is how it was born.
Yeah.
Right. So we're getting into situations like that where somebody says you broach the subject about charitable giving, and all you're doing is investing their money. Mm-hmm. So you don't really go any deeper than that. Don't want to overstep. They're not really sharing. And then something just comes out like, oh, I've already made plans in my estate for that. It's already taken care of my will.
Yeah, because I don't need to tell you. I need to tell the tax guy about my charitable contributions.
I don't need to tell the tax guy. I need to tell my attorney.
I guess for most of the time when people are doing charitable giving, right, they don't think of having to tell the advisor. They think about having to tell the CPA. Right, that's who they think that's a person that needs to know that they're doing charitable contributions. So I think unlocking them and just understanding that they actually do give, and then helping them explain how they're giving, what's the best way of going about it.
So where I find helpful, like in those situations where they've made plans in their estate, so then you start asking like, wait, why are you doing it like that? Mm-hmm. Usually what comes out is because I might need that money.
Mm-hmm. Right.
So then that's where I like to start with, okay, let's take a look at your financial plan. Mm-hmm. You are not even spending everything that you make. Mm-hmm. So you more than likely will never, ever need to
any of this.
Put your hand into the cookie jar over here. Right. So maybe we can afford to give some of it now. And, just to be extra sure, we're going to put this data into the software, or we're going to see if you can reach your goals. Mm-hmm. So you do two things. You get the tax deduction, and you get to see the benefits of your giving.
Yeah.
For a lot of people, for our charitable clients, that's important for them. Mm-hmm. So yeah, thanks for letting us get real for a second.
Yeah, Brooklyn in the house.
Yeah, please fact check that.
It's actually Stamford, Connecticut. Same thing.
There we go. The truth comes out.
Right.
Twins. They're sister cities.
So I tell you that a lot of folks I think have done that. Like they'll buy a life insurance policy for that. They'll be paying the premiums. So you're not even getting to, there is a way to deduct the premiums, but you're more than likely not even deducting the premiums. Mm-hmm. And then on top of that, what if that life insurance policy isn't even around when it's needed?
Right.
Right. Mm-hmm. That's a whole nother topic. That's check that episode out. But
we haven't recorded the episode, but check it out. It's coming out soon.
We talked about life insurance.
Just joking.
We talked about how life insurance can lapse.
Back to me. Is that last week?
Yeah. I mean, that's especially too, if I think it's so important if we can provide data-driven evidence to them, showing them and giving them that peace of mind, like, hey, what you want to do, it can easily be done, and you should have no concerns whatsoever to do it. And I think a lot of the time that's what they want. They just want that reassurance to be able to see, I can continue to live the lifestyle that I want to live for the rest of my life and still be charitably inclined and reap the benefits of that from a tax perspective, and then continue to see the fulfillment of what they're doing and how the organizations are benefiting from that. I think that plays a big part.
Yeah. Speaking of being able to see, the work of your monies. My wife is watching, so she told me I have to say this. We might have,
Your wife does not watch.
Not this far into it.
But she said, hey, you make sure you mention this. Okay? Our fans, we mentioned DAF's fancy remainder interest stuff, but I just want to tell our fans that you can give an unlimited amount to your spouse.
Okay.
Yeah, tax free.
Okay.
So that's all.
Wait, is that like an estate tax thing? Because you can.
I just got a little beep, a reminder to say it out loud. That's all it was. Sorry. Next topic.
Well, no. We're gonna just a quick blurb. You can give it an unlimited amount to your spouse or charity, estate tax free.
Yeah.
So just fun. I don't know if that's what you meant, but
not specific to spouse.
Not charity. I have no idea what you're talking about. Specifically for the spouse.
I think the cool thing about doing some of this stuff is that if your client has a good experience doing it and they tell somebody else that's doing it in client. So I think that's kind of the movement is hopefully that if one person's been able to help impact an organization through utilizing one of these tools and they let somebody else in Because that's typically what happens, right? Is that there's some sort of connection with somebody else that's doing the same thing, and now that they can take advantage of these same tax benefits. So I think that's a key thing.
Okay, let's talk about a couple of extra tools that people can take advantage of. Earlier, you mentioned CGA, charitable gift annuity. There was a new rule that came out a couple years ago. I think it was Secure Act 2.0, and I think it was about at the end of 2022. What it allowed people to do is people older than 70 and a half to give a qualified charitable distribution from their IRA directly to a charitable gift annuity or a charitable remainder trust. You mentioned some limits earlier. I don't know if that's what you were talking about. Would you mind talking about that QCD to CGA strategy a little bit?
So QCD, qualified charitable distribution, when you after 70 and a half, you're then eligible to make what are called QCDs. What that does, it allows you to take your required minimum distribution and do a direct charitable distribution with that required distribution from your qualified account.
RMDs don't start till like 73, right?
Right.
Yes.
So you can do it.
Some people had to take them after 70 and a half, but doing
Can I tell you what? Can a
doing
71-year-old now do a QCD?
Yes.
yes.
Yeah.
Correct.
That's
Yeah.
an awesome point, because usually most of our clients think they have to wait
Until RMD age. You
but
don't.
but you can actually do the QCD at 70 and a half, and they haven't changed that rule. So
No.
that's cool.
Yeah, that is nice.
Yeah.
No, it's okay. Yeah, so that's a good point. It's a really good point. So when they do that, they're not responsible for the tax on that distribution if it goes directly to a charity. So it's a really cool strategy for people that are already charitably inclined to be able to, instead of making that charitable contribution from your cash account, your checking account, whatever it is, however you were doing it beforehand, you do a direct contribution or direct donation to that charity. The strategy going from a QCD into the charitable annuity is you can do that, utilize the benefits of the QCD going into that annuity strategy. There is a limit as far as how much you can contribute. Currently right now it's $53,000, and that is a lifetime limit.
Okay.
That limit that dollar amount that goes in, you can then use the annuity strategy as far as making the donation, getting that tax benefit of making the donation into the annuity, and providing an income stream with that annuity at that point in time.
So when you take those money, the 53,000 from the IRA into the CGA, that's not a taxable event. That's tax free.
Correct. Yeah.
Okay.
There's no income tax owed when that money goes from the QCD into the.
I think that's a pretty big deal, though, right?
Only if I itemize?
At that point in time, no. I mean, it's QCD, so the point is to not have to pay income tax on that dollar amount. So the
Right, but do I
itemization
have to itemize to be able to do that?
to move it into the annuity. No.
Okay.
But why is that important? I think there's some big reasons why people want to look into lowering their taxable income, right? That's a big reason why sometimes people do this type of strategy.
Or I guess just stepping back a little bit, we have some clients that have retirement accounts, IRAs, and then they reach their RMD age, which used to be, I think, 70 and a half. Now it's 73. And we have clients that are fortunate enough that they don't need their required minimum distributions. And at the same time, they're already giving.
Right.
And then with the QCD, once you do a QCD and give those monies to a nonprofit organization, it's no longer taxable. Because for those clients that don't need the RMD, one of their biggest gripes is, James, I don't need this money, but I'm forced to take it out and it's taxable. And right away, knowing which clients are gifting, you can identify, well, you're already gifting to that or giving to that organization. Why don't we just turn around and take out, gift your RMD? Now it's not taxable. And so it makes it really, really easy to have that conversation.
Yeah. Once again, I find it helpful to use numbers because you don't have to give your entire RMD. As we mentioned, you don't even have to be RMD age. You just need to be 70 and a half. So for example, let's say your RMD is 40,000, but you give $10,000 a year. So give $10,000 directly from your IRA to the charity. Now you only have to take $30,000 to meet your $40,000 RMD, and that $30,000 will be taxable, not the entire 40. And you don't need to itemize. It's an above the line deduction, which is even more beneficial because it could potentially reduce your Medicare premiums, health insurance premiums, make you eligible for other deductions and credits. So again, going back to a different episode, anytime you get to reduce your AGI, the better. I think it's also important to state that you can, it doesn't have to be a QCD to a CGA. You can do a QCD directly to a charity.
Yep.
And then the recent change in law allowed the QCD to CGA.
Yeah, it's funny because QCDs were introduced, I think, Pension Protection Act 06, and every year.
06, man, you going
2006, and every year it's been renewed almost. So until I think Secure Act when they implemented permanently, but it was something that every single year was reviewed, determined. Oh yeah, we want to allow individuals to keep doing this for one more year. Reviewed again. Congress said, okay, we can do this another year. And so now we're at a point where they've realized it's a good thing. And that's why I think that there was no age adjustment and change as far as qualifying to be able to do that. Because I think it's just difficult to be able to have that change along with RMD ages and trying to meet that all. It's just like, okay, like qualified distribution without penalty. It's like, all right, this is just the age. Anything after that, you're qualified.
And when going back to Enrique's example, you said the RMD was 40,000.
Yes.
I think his example was the RMD is 40,000, but you don't have to do a QCD for the entire 40. But it's also, you can also go the other route. Even though your RMD is only 40, you can still do up to $100,000 as a QCD. So it kind of goes both spectrums. And if you do 100,000 QCD, that's all tax free. It's also probably worth noting that when you do a QCD, you're gonna get a 1099-R, and it's not gonna. There's no box that says this amount is a QCD. So you have to work with your tax professional to let them know, hey, this amount is my RMD, and this is the amount that went to as QCD. It'll be in your 1040, I believe, line 4. It'll show how much you took out that's from your IRA is taxable and how much will be non-taxable. So something to keep in mind that you're going to get a 1099-R, but it's not going to say that how much was a QCD. So
I promise I didn't keep all the money. I promise.
I love it that you always bring like real world practical application.
Really?
Yeah, because I'm going to piggyback real world application. I usually recommend clients to figure out early in the year, like January or February, if you're going to implement the QCD strategy. Because sometimes when we first started helping clients with this, we talked to them. Most people like to wait till the very end of the year to take their RMD. So we're talking to them in December, telling them, hey, did you know about this qualified charitable distribution? And they would say something like, oh, well, that would have been good to know in January because I've already done all my charitable giving. So that was an aha moment. So if you do plan on implementing this strategy, you might want to start earlier in the year. You do need to be 70 and a half at the time of, I believe. And you can also do QCDs from inherited IRAs, I think. But you still have to be 70 and a half.
I think in general, though, it helps to have a good idea to start planning for these charitable gifts at the beginning. You know, having an idea in January and February, it makes it a whole lot easier to run the software to get, but how is this going to impact you?
You can do QCDs from any qualified account, correct?
I was hoping you were going to look at that.
That's what I saw. Okay. Yes.
There you go.
That's a yes.
Well, anything that you have RMDs from, you're eligible to do a QCD with that RMD.
Okay.
That's true because is a Roth qualified account? You can't do QCDs from there.
I don't know why you would want to.
I was going to say, let's go back to that conversation about being the kid and receiving assets, right? We don't want to do it from the Roth.
No, Mom. Not that one.
No. Please, no.
Well, you see, Mom, tax rate arbitrage.
Hey, I did try to sell her investments when I was about 13 years old, and she said no. She didn't have the funds. So.
All right.
Before we wrap up, again, I find numbers to be helpful. We're talking about CGA And earlier offline, you're kind of giving some examples, percentages amount. So what does that look like to this point? I think the max is 54,000 or so. So let's say you give, well, easy again, 50,000. Let's say you do 50,000 from a QCD to a CGA. Like what does that look like? Like how much income do I receive
on what 50,000?
Yeah, like or how's that calculated? Is it like is it a set percentage? What?
Yeah, so I think they're based off of interest rates, right? So rates have an impact on them. Age has another factor in regards to the amount of the payout, right? So the older you are, shorter life expectancy, so you'll typically receive higher payouts. If you're younger, you'll typically receive lower payouts because of longevity. But rates are a big factor, so interest rates affect the amount of the payouts.
So we get like 1%, 2%. Do you have a range?
So
I know, of course, nothing specific, right? Because we don't know. It's
so on the simple, some of the simple numbers I was running off of, 10,000, you're somewhere about $60 to $80 a month based off of life expectancy. So, right, if we were going to go to 50,000, right, multiply that by 5, so around $300 to $350, $400 potentially a month that could be going directly to an organization, just based off of what rates are.
okay. You said $60 to $70 a month off $10,000. So 60 a month is 720. 720 divided by 10,000, 7.2%. So about 7%.
Yeah,
And
pretty
this is
high
off all public website, not
Yeah, just looking at just some of the simple options that are available through Google.
just a quick Google search will get you that. So I can forego paying taxes on $50,000 from my traditional IRA, get a 7.2% payout for the rest of my life. When I get that 60 to 70 bucks, how do I owe taxes? Do I not?
Yeah, so I believe a portion of it is taxable, a portion of it is gains, and then obviously the charitable amounts are deductible.
But if it's from my IRAs, there's no gains, right? Like, so is it?
So I guess in some of those, they might have some of the interest, right? Some of the interest that's accruing in the account.
Yeah, the whole thing would be taxable to you if it's coming from your IRA.
Yeah, but you're spreading it out.
Right.
Yeah, that's the key thing versus paying taxes on 54. So
at one point in time,
something to make sure our fans understand.
Yeah, one thing we didn't bring up really quick as well too, in considering deduction amounts, especially at the age and this age group and this demographic specifically. IRMA is an important consideration in regards to how much income individuals or married filing jointly couples. So taking into consideration where you're at with your AGI is really important because there are certain thresholds in which you have to pay a higher Medicare premium depending on what the total income is. And so being charitably inclined and utilizing some of those benefits and taking into account bundling and taking into account some other things can also help with lowering AGI so that you're not affected by IRMA as well too. And that's something that when we run proposals and we're doing some of the illustrations, that's it. Those are different things that we want to look at and take into account. And the software does a fantastic job of notifying us and literally showing and triggering certain AGI income points that affect other things that may not be in consideration when you're taking that into account.
I just remembered when we were talking offline, I usually like to encourage people, like, don't give for the tax deduction.
Right. Yeah.
Like if you're going to give with your heart. Don't give for the tax deduction.
Correct.
Yeah.
The strategy is in the sense of what we were talking about with bundling as well too, right? So when we're looking at utilizing certain strategies, it may behoove individuals, and that may be an ancillary benefit on top of the philanthropic the philanthropic intent that they already have. So
spell it without spell check.
No way.
Can you put in a sentence?
ANCILLARY. Okay. Please let me know in the comments if
ancillary. Can I get the language of origin, please?
Thanks for tuning in to another episode of Our 2 Cents on Your Dollars.